Welcome, everyone. We are very excited to have all of you joining us today. My name is Daniel Blake, and I'm the CEO of UI Charitable Advisors. And today we are going to be talking about the use of donor-advised funds, specifically in private business sales. And I'm thrilled to be here with my good friend, Dean. Dean, would you like to quickly introduce yourself?
Yeah, hi, my name is Dean Colvin. I've been a valuation professional for over 25 years and have a substantial focus in the trust and estate and gift tax area, and look forward to talking to you guys about some valuation issues related to gifting today.
Awesome. Well, we will go ahead and jump into this. So today we're going to go through first just why charitable strategies matter, and why they can be a really useful tool when you are dealing with the sale of a complex asset, whether that's a private business, whether that's a piece of real estate. We're also going to be talking about planning for the lifetime gifting and exemption changes. We will go through two specific case studies that hopefully are just really practical and helping you understand how you can incorporate this into your practice. And then we'll talk specifically about what makes the UI charitable DAF different from other donor advised funds out there. So just jumping straight into this, why charitable strategies matter. So there was a benchmarking report that was done. It looked at 1,200 independent RIAs and family offices, and it looked at those that included charitable planning compared to those that did not include charitable planning in their services. And I thought these stats were really compelling uh, when the client was asked, "Do you trust your primary financial advisor to make decisions that are in my best interest?" Those that included charitable planning scored 7% higher. When asked the question, does your financial advisor demonstrate that he or she is considering your unique needs, goals, or preferences? They scored 13% higher. And I think perhaps the most compelling is when asked, do you view your financial advisor or your wealth manager as a multi-generational resource to your family? They scored 27% higher. And given the amount of wealth that's currently in flux, moving from one generation to the next, including charitable planning is one of the single best things that you can do to stay relevant during that conversation and really show how valuable you are from one generation to the next. And so I'm going to turn the time over to Dean to really set the stage with the lifetime gift exemption changes.
Great, thanks, Dan. Yeah, one of the most important things that's at the top of everyone's mind these days is the Tax Cuts and Jobs Act of 2017 went into place in 2018, but it had a sunset provision in it, and that sunset provision is December 31st, 2025. And so that's why everyone is like talking about this at this point in time, because what happened back in 2017 is they changed the lifetime federal tax exemption for gifting from around 5.5 million up to 11.2 million approximately. And so that made a very big difference. And that's been adjusted for inflation throughout the years, but it's set to sunset in December 31st, 2025. And currently, just after adjusting for inflation in 2024, that dollar amount is now 13.61 million per person. So if you have married couples, you're allowed to combine that together for a total lifetime gifting exemption of 27.22 million per couple. And that's in the issue here going that we're concerned about is that in December 31st, 2025, it's set to sunset and go back to the original approximately $5 million of a lifetime exemption, which, after adjusting for inflation and so forth, in 2026, when that would actually be in effect, would be about $7 million per person. And so compare that $7 million per person to what you can get gifting to either your family or to charitable causes as of today in 24 and 25 of 13.6 million. It makes a huge difference. And so that's the biggest thing on people's minds at this point and for the next year or so is if you're going to do estate planning, whether it be trust planning for your family or charitable planning, then you need to get it done, and you need to plan early to get it planned and done ahead of the deadline of December 31st, 2025. It's just one of the most important things that everyone's talking about these days. So go ahead, Dan. And just in relation to gifting, one of the things that's really important and why I'm part of this conversation is the IRS requires you to have an independent third-party valuation that'll stand up to their stringent guidelines and adheres to all the IRS guidelines and court cases that are out there. So you need to make sure you're getting any gift that you're gifting to, whether a charitable cause or for your own family or trust causes, you need to make sure that you get an independent valuation performed of the asset that you're gifting. And just a list at the bottom here of typical gifts that are gift in these instances. And for this purpose of this presentation, we're mainly talking about closely held operating business or interests in closely held businesses. So if you're going to gift a closely held interest in a business, you gift it out ahead of a transaction, maybe many years ahead of a transaction or sale. You need an independent valuation to help support the conclusion of value that you're gifting for either charitable purposes or for your trust purposes. And across the bottom here is just a list of other types of assets people commonly gift: interest in general partners or LPs, sometimes real estate, and then sometimes some very exotic types of interests that can also be gifted. And we can talk about those in more detail later. So go ahead, Dan.
Awesome. So now that we've set the stage with why charitable strategies matter, the importance of the lifetime exemption and that sunsetting, I want to jump into donor advised funds, in part because donor advised funds are just such an incredibly flexible tool to help you help your clients with their charitable goals. And so just what is a donor advised fund? A donor advised fund essentially is a giving account. It's an alternative to a private foundation. And so you have a donor, and the donor contributes to the donor advised fund. And when they do that, they qualify for a tax deduction. You now have assets in the donor advised fund. It becomes essentially your giving account. And you can make grants out of your donor advised fund to nonprofits or various different social ventures. And so it's a fund that you can use to accomplish all of your charitable goals. And so what this is doing, and this is a simple concept, but it's a really powerful concept, is it's separating out the timing of your tax deduction from the timing of your charitable giving. And by doing that, you're able to optimize for both. And so you can now go through and donate to the DAF when it makes most sense from a tax standpoint. And then independent of that, you can then fund nonprofits and social ventures after you've done your due diligence and you've gone through a deliberate process in deciding what organizations you want to support. And so again, what the power of a DAF is really separating out the timing of the tax deduction from the timing of how and when you support different charities and social ventures. Like I mentioned, a donor advised fund is oftentimes an alternative to a private foundation. Given how familiar most people are with private foundations, but not familiar with donor advised funds, I do just want to quickly illustrate how they're similar and how they're different. So fees and setup. A donor advised fund is a part of a public charity. And so setting up a donor advised fund is almost immediate. You can set one up in typically, 5 to 15 minutes. All donor advised funds are going to charge a DAF admin fee, which ranges from 1% down to 0.1%. At UI Charitable, our fees are 0.6 to about 0.1%. So it's a really low administrative cost. There's essentially no startup costs associated with donor advised funds. Whereas with a private foundation, it's its own independent entity. And so you have to create the entity, you have to file for tax exemption with the IRS, and that can oftentimes take several months. And the startup costs, the setup costs are typically pretty high because you're having to hire an attorney and an accounting team to help with all of that setup and all of that compliance. If we now look at the causes that you can support, both donor advised funds and private foundations, can send grants to domestic and international organizations. They can both engage in impact investing. The biggest difference between the two is you can only send grants to individuals from a private foundation. You cannot do that through a donor advised fund. And practically speaking, where this comes into play is in the form of scholarships. If you want to host your own scholarship fund, you would need a private foundation to do that. You could not do that through a donor advised fund. But if you just want to support a scholarship fund, you can work, oftentimes it's going to be with a school or a university that will host the scholarship fund, and then you can just fund those scholarships. So it's the university that's managing the compliance and the administrative headaches associated with those scholarships, and you're just supporting them as a funder. Donor advised funds are currently the fastest growing charitable vehicle, and there's a huge trend of people shutting down their private foundations and moving those assets to a donor advised fund. That's in large part because of how much more tax efficient donor advised funds are compared to private foundations. With cash donations, you have a 60% AGI limit with a DAF compared to 30% in a private foundation. Short-term capital gains in a DAF is at 50% compared to 30% in a private foundation. Long-term capital gains is at 30% in a DAF compared to 20% in a private foundation. But the real kicker, and why this is so important for private businesses and non-public securities, in a donor advised fund, all securities are valued at their fair market value. In the case of a private foundation, that's only true for publicly traded stock. Non-public securities are valued at the cost basis. So you get no benefit of appreciation in a private foundation. The last one, in both, you can set up succession plans and they can exist into perpetuity. Donor advised funds have no required distributions. Private foundations have a 5% minimum on an annual basis. And it is possible to be anonymous with your giving through a DAF. It is not possible with a private foundation. So hopefully this helps illustrate why donor advised funds are as popular as they currently are. So when should you use a donor advised fund? In the case of a liquidity event, estate planning, retirement planning, you're currently making donations to multiple charities and you want to streamline the reporting. You want to create just overall flexibility in the timing of the grants to charities, or your clients interested in anonymous giving. So again, DAFs are just incredibly flexible and really are the best tool in most instances. So a couple of things that set our donor advised fund apart. You're going to find a lot of donor advised funds out there. Fidelity Charitable is the largest. You have Schwab Charitable, Vanguard Charitable. Most community foundations host donor advised funds. So just as you are looking at a donor advised fund host, I would recommend that you always look at these three points. One, can the DAF accept the asset that you want to contribute or that your client wants to contribute? In the case of private business interests, you are going to find a lot of community foundations don't want to deal with it. They're not comfortable with real estate. You're going to find most people don't want to work with S corporations. At UI Charitable, we accept any type of complex asset. If you go back to the list that Dean shared of all the different things that you could donate, we have a very streamlined process to accept all of those different types of assets. The second area is we have open architecture, allowing you as the financial advisor to continue to manage those assets the exact same way that you manage any other asset for your client. Then the third is the flexibility in giving. Like I shared when we were comparing DAFs to private foundations, DAFs are really flexible in what they can support, but a lot of DAF hosts have placed internal constraints on what you can do. Most DAFs don't allow for international giving. And so it's really important to understand who you can give to, what restrictions different donor advised funds have. At UI Charitable, our goal has been to give the financial advisor and the donor as much flexibility as possible. And so we're going to jump into two quick case studies. This first one is really used to illustrate the benefit of separating out the timing of the tax deduction from the timing of your giving. And then the second case study, and I'm going to pull Dean in to help me with this, is looking at specifically the gifting of private businesses. So let's jump into charitable bunching. What this is you are front loading multiple years of giving into a single tax year. That allows you to claim a really large itemized deduction in year one, and then in all of the subsequent years, you would just claim the standard deduction. So let's take a look at this. So let's look at a scenario without charitable bunching. You're working with a married couple, they donate $15,000 a year to several different charities. So we're going to make some simple assumptions. So $15,000 a year donating to charities, state and local taxes, mortgage interest. So their total yearly itemized deductions, $31,000, slightly above the standard deduction. So their additional deductions, $3,300. If we look at this over a 5-year period, the total donations to charities, $75,000, and the total tax deduction is $155,000. So now if we shift it, and the only thing we're going to change is the timing of their giving. We're going to take that full $75,000 and put it into a donor advised fund in year one. So now their total itemized deduction has all of a sudden increased to $91,000, significantly above that standard deduction. In years 2 through 5, they're just going to claim the standard deduction, which is currently $27,700. So the tax deduction years 2 through 5 is just over $110,000. So nothing has changed with the amount that they're giving. It's still $75,000, but the total tax deduction has now increased to just over $200,000. So without charitable bunching, if you're not optimizing for taxes and you're just giving when you want to give, your tax savings above the standard deductions, $16,000, just over $16,000. With charitable bunching, if you really optimize for taxes, your additional tax savings over that same 5-year period is over $60,000, over 3 times more the tax savings over that 5-year period. And the only thing that you changed was the timing of your giving. Again, that's the power of ADAPT in separating out the timing of the tax deduction from the timing of the gifts that you are sending to different charities. So now let's look at a private business. Let's assume you're working with a family, they're selling their business for $10 million. They want to be charitably active in retirement. You, the financial advisor, you suggest that they donate $2 million in equity prior to the sale of the business to their DAF. And so let's look at 2 scenarios. What most people do is this first column. They donate after the sale of the business. They use cash to make a donation. So let's just run through this really quick to set up the comparison. You have the sale price of $10 million, cost basis of $100,000. We're going to assume that they started the business, so it's a really low cost basis. So the taxable amount's $9.9 million. They're going to pay $2.6 million in taxes. Their after-tax equity is 7.3. They now use cash to make a donation of $2 million. Their final equity is 5.3. They qualify for a gift tax deduction for that $2 million gift. And the income tax savings, we're going to assume a 44% tax bracket between federal and state. So the final equity plus the tax savings is at $6.2 million. Now, instead of donating cash, let's transfer $2 million worth of equity in the business into the donor advised fund. You still have this cost basis of $100,000. Now the taxable amount has decreased to $7.9 million. So the taxes that you're going to pay has also dropped to 2.1 compared to this 2.6. So by just changing the timing and donating prior to the sale and donating equity instead of cash, you're saving $500,000. Your after-tax equity is 5.8. You're making no additional donation post-sale. When the business sells, that equity that's in the DAF is going to convert into cash. And you still qualify for a gift tax deduction. And Dean's going to talk about some discounts that you might see with that tax deduction. Like he mentioned, you have to go get a third-party appraisal to determine the fair market value of that gift tax deduction. We're going to assume that the income tax savings are in that same ballpark of $880,000. So the final equity plus the tax savings in this case is increased from 6.2 to 6.7. by just changing the timing of your gift, you're able to save a tremendous amount on taxes. And so I'm going to turn it over to Dean to really dig into the details of how this works, what the appraisal looks like, and what the IRS is going to press on in these scenarios.
Thanks, Dan. So one of the important parts that we need to do is appraisers like myself, evaluation professionals, when we're doing evaluation for gifting purposes like this to a charitable cause, we'll need to do evaluation, and then we'll also need to fill out a form called the 8283 form that the taxpayer ends up submitting along with their filing. And that basically is a form that valuation professionals like myself sign stating, this is true fair market value indication based on all the regulations that we have to do valuations by. So it's an important thing that goes along with your filing of your taxes for the gift purposes. But getting back to the valuation part of what needs to be done, when Dan was talking about gifting a $2 million interest out of a $10 million company, that $2 million interest is not a controlling level value of the business. It's a non-controlling level of the business. So when you're thinking about from a valuation standpoint, we need to adjust for things that someone would pay less for if they were buying that non-controlling interest of the business. And typically those things are adjusting for a discount for a lack of control, or a discount for lack of marketability, and sometimes also lack of voting rights. Go ahead to the next page, Dan. So, and I won't get into the weeds on all of this, but basically a discount for lack of marketability is if you're gifting non-publicly traded stock, like the stock of a private company, it's not readily marketable. You can't turn it into cash the next day. There's a long process of selling private businesses and companies, and it takes time and money to turn a private company into liquid cash. So the fact that you can't turn around and sell your publicly traded stock like you normally could in your in one of your investment accounts and get cash for that the next day means that there's a discount for lack of marketability, because you cannot get cash immediately or within a couple days. So that's a very common discount that is applied. And then lack of control as well. We'd end up applying a discount for lack of control, because for a 20% interest in a business, you're not going to control the interest. You're not going to be able to direct the business in any specific strategic ways, or make them do anything, or make them sell. So there's also a discount for lack of control, because you can't do those things. So these things are typically taken into consideration after we conclude on the value of the business and the entity and the interest being gifted. Okay, go ahead, Dan. The way we typically go about valuing a business interest, and I'm just going to go over the most common ways here, is there's three main approaches. There's an income approach, and there's two types of market approaches, which is a public company market approach and a private transactional market approach. So in talking about the income approach, basically what you're doing is you want to get a present value of the future cash flows of the business. So typically you would do a forecast of the business going forward a number of years. You'd forecast out the revenues and profitability and get down to the cash flows of the business that are going to be anticipated to come over the next number of years. We're then going to adjust those for the risks inherent in achieving those forecasts. So we'll apply a weighted average cost of capital to those cash flows and bring the future value of those cash flows to a present value to come up with the value of the overall company as of today based on the cash flows. So that's one way of looking at it. The other way of looking at valuing an interest, and you typically want to do all these at the same time when you're analyzing the business. You don't just want to use one methodology. So then separately, we would use the market approach. One of the market approaches is that of a publicly traded company. One second, please. So we'll look at the company that you're donating the stock in and try to find the most comparable publicly traded companies there are. And quite often for a private company versus a public company, there's a lot of substantial differences in there. but you try to get as close as you possibly can on the type of business and the niche that they're following in an industry, and the revenue growth, the size of the company, the profitability, what their EBITDA profitability is and margins. And you'll look at those comparable companies and select the ones that are most comparable to your company. Look at those multiples, and you can pull together an analysis by applying the typically an EBITDA multiple to your company's EBITDA, and sometimes as well as a revenue company, depending on what kind of company you're looking at. But you'll take those multiples, you'll apply them to the metrics of your company, whether it's revenue or EBITDA or whatever, and that will help also imply a value for the overall company that you're dealing with. Same thing for private transactions. There's private transaction data out there. And so we'll go out and find that private transaction data and pull it into the analysis. And typically, so when we come together, we would do those three approaches: an income approach and the two different kinds of market approaches. And you'd kind of triangulate in on a value conclusion of the overall business. Just to mention here at the bottom, there's also cost approaches or asset approaches. Those are usually for holding companies, such as a holding company that might own real estate that you might be gifting or something like that. But the top approaches here, the income and market approaches, are the main ways of coming up with valuations for the company. Go ahead. Lastly, I wanted to talk about, this is a little bit of a niche interest, but a lot of people that own interest in private equity funds or other types of funds will get what is called a carried interest. And they only get this carried interest if the fund itself exceeds some kind of hurdle return to its investors. So, but then a lot of people that own these funds try to take advantage of that by, if they're going to do gifting, they'll gift early on before a ton of value has been created in those funds and those investments. So they'll gift it to their family trusts or other trusts that they've set up. But in the case that where you haven't taken advantage of the gift of the carried interest and the corresponding vertical slice, what you will do at the end of this, if you're about to get a really large return on your carried interest, you can take that into account and for your charitable causes. So if you know you're going to get a very large interest coming out of your carried return on your carried interest, you can take into consideration some of your charitable gifting and take that in place when typically right before or around the time where you know it's going to come out, but at least it gives you an opportunity to do some charitable gifting. So go ahead, Dan. Dan, you're muted.
Thank you very much, Dean. So just to recap, donor advised funds really are a very flexible tool when you're looking at incorporating charitable strategies into your practice. They can accept a wide variety of assets, just like Dean just went through all the different types of assets that you can donate. There's then, we have a very open architecture allowing for consistent account management and greater flexibility in the organizations that you give to.
And then this is just a list of some of the different types of deliverables we have helped with in the past. Top left, there's all the charitable stuff and different types of gifting that are necessary. The main thing here is from a valuation standpoint, and to assist folks like Dan in your charitable gifting, you need to make sure you cover yourself from both tax implications and penalties by getting independent valuations or appraisals of whatever asset that you're going to be contributing for your charitable cause or your family trust, whatever it is. You just want to make sure you're covering yourself. And so the IRS can't come back at a later day and say you didn't get an independent third-party valuation and then have some major implications upon your gifting and taxing.
Awesome. And so as we wrap up, we have a couple of questions. And so this first one is for you, Dean. What valuation approaches are most accepted by the IRS?
For businesses, it's typically the ones that I went over: the income approach, a market approach, and you want to try to get as many of the market approaches you can, both the public and private transaction data. If there's any transactions in the company's stock itself, those are also very relevant in looking at. Sometimes there is, for private companies, there is purchases of the company's stock, so you can look at that as well. But all of those and any other evidence of the value of the shares of the company you're looking at need to be taken into consideration.
Got it. And a follow-up question, how is the valuation date determined if a business is donated prior to the sale?
Yeah, it's the valuation is done as of the date of the gift. And so, we would basically do that valuation around that time of the gift and conclude on the value of it at that point in time. And if it ends up being gifted to the charity, there might not be a liquidity event for many years beyond that, but the valuation date of the gift is the date that it's gifted.
So given the time this is going to be the last question, what happens if the valuation that from your report at the time of the gift is vastly different from the sale price of the business? Like you just mentioned, the sale might not happen for a year, maybe 2 years. So is there any risk to the tax deduction if the sale price and the valuation price are significantly different from each other?
Gift and the sale are around the same time, there really shouldn't be much of a difference. And if there is, then you're going to have a lot of issues to answer to. But typically, you're doing gifting many years ahead of a liquidity event. And so there's a lot of really strong reasons why there could be a material difference between the value that you gifted at and ultimately what it ended up getting sold at. I mean, the company could have grown 2 to 3 times as much, or it could have grown by 20% over that time period, and therefore it would be a materially different in value. So that's why it's so important to have an independent valuation as of the date of the gift. So when the IRS says, "Hey, well, hey, they sold it for this, why is there a difference?" You have that as evidence to support yourself.
Got it. Well, thank you so much. If you have any questions, feel free to reach out. We have the websites for both of our respective organizations here. And thank you so much for spending your afternoon with us.
Thank you all.